When developing a financial plan, people tend to focus on the exciting stuff, like how much they're going to invest, what they're going to invest in, and how that's going to compound over time to create financial freedom. However, a good financial plan should include risk mitigation strategies for when things go wrong. And one of those risk mitigations is income protection. While you're on the journey to build financial freedom, your income really is your greatest asset because it's the thing that you're going to use in order to save, invest, and cover living expenses as you go. So if you lose your ability to earn an income, you can basically kiss financial freedom goodbye. But despite this, it amazes me how many people are willing to insure their homes, their cars, their pets, and even their phones, but they're not willing to insure the one thing that pays for all of this stuff, and that is their income. So today I want to bring a little bit more awareness to income protection so you understand how it works, how to get it, and you do the prudent thing when putting together a financial plan and include that element of risk mitigation. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about income protection. And before we get going, I just want to give you the heads up that we do have a pretty slick process to help people quote the market and find a good income protection policy that suits their situation. So if you did want help with that stuff, I'll put a link in the description box below and you can go and check that out. But for now, let's jump in. Income protection is an insurance policy that provides a monthly benefit if you're unable to work due to accident, illness, or injury. Now, I hear a lot of people ask, well, isn't that what workers' compensation is for? And the answer is no. Workers' compensation is a policy taken out by your employer which covers you as an employee if you're injured at work or become sick due to your work. But if you have a sickness, injury, illness outside or unrelated to your work, well then workers' compensation is not going to pay in that event. That's when you need an income protection policy. Primary components of an income protection policy are your monthly benefit, your waiting period, and your benefit period. And we're going to talk about all of those components in detail right now. The monthly benefit is your sum insured. So it's the amount of money that you're going to receive on a monthly basis if you make a claim on the policy. The maximum monthly benefit you can apply for is 70% of your gross income. So for example, if you earn $100,000 per year, your maximum monthly benefit would be $5,833. Now you don't have to apply for the maximum monthly benefit, you can reduce it. So for example, if your maximum benefit is $5,833, like we just talked about, but you only need $3,000 per month to cover basic living expenses and that's enough for you, well then you might want to apply for a monthly benefit of $3,500. And the reason why I didn't say $3,000 per month, which is exactly in line with what you intend to spend, is because an income protection benefit is taxable. So you have to factor in the tax payable on that amount if you were to make a claim, so you're left with the right net or after-tax amount. The waiting period is how long you need to be off work for before you can make a claim on the policy. And so generally waiting periods range anywhere between 14 days and 2 years in set increments. The shorter the waiting period, the more expensive your cover is going to be. So you really need to tailor that waiting period to suit your financial situation. So for example, if you have an emergency fund in place, which is going to cover 3 months of living expenses, well then you might want to apply for a 90-day waiting period. You may also want to factor in accrued sick leave and annual leave that you have with your employer. Just as a word of caution, if you do factor in your sick leave and annual leave into your waiting period, then you want to be fairly certain that you're going to remain with the same employer for the foreseeable future. Because if you change employers and you lose those benefits, you can't actually reduce your waiting period without going through medical underwriting again. And we'll talk a little bit more about medical underwriting later. Also, just remember that monthly benefits are generally paid in arrears. So what this means is that if you have a 30-day wait, you're generally not going to get a benefit until 60 days after you've ceased work. The benefit period is how long the policy is going to continue paying for if you're unable to work. And this can vary anywhere between 2 years and to age 70, again in set increments. The longer your benefit period is, the more expensive your cover is going to be. So again, you need to tailor your benefit period to suit your particular financial situation. So for example, if you have an income protection policy with a 30-day waiting period and a to age 65 benefit, it means that that policy is going to start paying after 30 days of being unable to work due to sickness, illness, injury, and it will keep paying right up until age 65 if you're unable to return to work. There are some instances where you might want to reduce your benefit period. So for example, if you are 35 years old and you're on track to achieve financial independence by age 40, well then maybe you only want to apply for a 5-year benefit because that's going to see you through to the time where you're still reliant on your income to cover living expenses. You have the option to structure your premium both inside and outside superannuation. So if you structure it inside super, the premium is going to be paid from your superannuation fund. If you structure it outside superannuation, you're going to have to pay the premium out of your own pocket. Typically, I like to structure income protection policies outside of superannuation for the tax benefit. So for example, if you're on the top marginal tax bracket of 47%, which includes Medicare levy, and your income protection premium is $2,000 per year, well then the net cost of the cover after factoring in the tax benefit is only $1,060 per annum. On the other hand, if you fund the same premium via super, your superannuation fund is going to claim a tax deduction and the super rate is only 15%. So this essentially gives you a higher net cost at $1,700 per annum. If your cash flow is tight and you don't really have the capacity to fund your income protection outside of superannuation, well then it's better to fund it inside super than not have it all. But just remember that when it comes to income protection, if you can't afford to have it, well then you also can't afford not to have it. The cost of your income protection is going to vary depending on a huge number of factors, including age, gender, occupation, smoking status, and the policy features that you apply for. With regards to occupation, if you have a sedentary role, then you're going to get a lot cheaper premiums than someone that has a manual occupation. And the reason for this is simply because you're less likely to claim on the policy. For instance, when I tore my ACL and I had to have surgery on it, I didn't need a claim on my income protection because it didn't really affect my ability to work. I can basically sit down most of the day if I choose to. But if, let's say, I was a bricklayer, then I potentially would have been on claim for months because that's an occupation where it's manual, you're walking around all day, and your knee's quite important to that. All insurers price their occupation categories slightly different. So some are really good for sedentary, some are good for manual. So it is important to shop your cover around based on your occupation to ensure you're getting a good deal. You also generally have the option to apply for a stepped or a level premium. A stepped premium is going to increase in cost as you get older. A level premium, you're going to pay more initially, but it's not going to increase as a result of age. Generally, I don't really like level premiums, and the reason is because for me, insurance feels a short-term need. It's there while I'm reducing my debts, building up my asset position, and on my journey to achieve financial freedom. But as I get closer and closer and closer to that target, my need for cover reduces, and so why would I want to lock in a high level of cover at the start and pay more when my need for cover is going to reduce in the future? Also, insurers are notorious for increasing their premiums due to product repricing, and a level premium is not going to stop that. And also, just because one insurer is the best for you at this stage doesn't mean that it'll still be the best policy in a couple of years' time. You might look to switch in the future. There are two general categories of insurance policies out there: group insurance and retail insurance. And now I would highly recommend you opt for a retail insurance policy, particularly when it comes to income protection. A group insurance policy is a form of pooled insurance arrangement which is offered by most super funds. Generally speaking, the benefits and options offered through a group insurance are a little bit more restrictive. Also, they're not medically underwritten, which may mean that an automatic exclusion clause applies to pre-existing medical conditions. This could leave you in the awkward situation where you think you're covered, you go to make a claim, but the claim gets rejected due to something in your past. A retail product, on the other hand, allows greater flexibility to tailor the cover to your situation and your requirements. For many low-risk occupations, a retail policy is also often cheaper. Importantly, a retail policy will be medically underwritten at time of the application. This process does take longer than cover that's not underwritten, but results in far greater certainty for you at time of claim. To get a retail policy in force, I would highly recommend you speak with a financial advisor, because as advisors, we have access to different products and different policies that you just can't get by going it solo. Also, we can provide some advice as to exactly how much cover you need and make sure it's structured tax effectively. If you don't have an advisor and you'd like our help, you can jump onto our website to get the process started. Simply go to guidedinvestor.com.au/personal-insurance, click on Get Started, and you're going to be directed to an online form where you can tell us a little bit more about your situation. Once the form is complete, you can book in a 30-minute consultation via Zoom or phone where we'll talk about your insurance options. The underwriting process involves a series of questions about your medical history, and this is often done either with your advisor or with the insurer directly via a tele-interview. Generally, there are no mandatory medical requirements when applying for cover unless you've got a really large sum insured. But if during the underwriting process there is some medical history that the insurer wants to know a little bit more about, they may request a report from your doctor, or they may also request further tests and investigations be done. If you do have a pre-existing medical condition, the insurer might put a loading or an exclusion on your policy. And so a loading is where they increase the cost of your cover to allow for the extra risk. And an exclusion is where they basically say you're not covered in certain events. So let me give you an example of an exclusion. So I have torn labrums in both of my shoulders, and there's a very good chance that at some point in the future, I'm gonna need to get surgery on them. So if I were to apply for an income protection policy now, it's likely that I would get an exclusion on my shoulders, which basically meant that if they got worse and I did have surgery on it and I was off work as a result of that, well then I wouldn't be covered by that income protection policy. However, let's say that I was in a car accident and my shoulder got ripped out as a result of the force of that car accident. Well then, that's a scenario where even if I had an exclusion, it's not related to my existing condition. So in that instance, I'd still be covered. But it's very important that if you do get an exclusion placed on your policy, you read the terms of the exclusion and you make sure you understand them so you know when you are and aren't covered. It is a lot easier to go through this underwriting process when you're younger and you haven't had a lot go wrong medically. I was lucky enough that I got my cover in my early 20s, so there is no loadings or exclusions on my policies, so my shoulders are actually covered. There is a term in the insurance world called clean skins, and this basically means that you can answer no to all of the underwriting questions. So your insurance goes straight through, goes in force with no loadings or exclusions. And it's often best to get cover at a young age while you've still got a chance of being a clean skin. So I hope you found this information useful and you have a better understanding about how income protection works. Now just remember, if you're looking to replace an existing income protection policy, then please don't cancel your old policy until the new cover is in force. And particularly with income protection, there are a lot of industry changes back in October 2021. So if you had a policy prior to this date, there might be some benefits associated with that policy that if we were to cancel them, you can never get them back. So you just have to be a little bit careful. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up and I will see you guys in the next one.